Happy Labor Day to all SMF Street traders who are enjoying their vacation and people around the world and our international traders. Hedge fund managers, I know that you're out there having a great time, so if I were you, I'd start getting with the program. The thing that we're going to be looking at here is this is an $1,110 call on this particular chart. Over here is the same strike, 1110 put on the S&P 500 SPX. You can see put, call. Now, as we look at where this contract over here, I want to go back and show the MMTs on this video here, is that when I click on that bar, the high of that contract was $110. We were involved in that move. The bottom of that move, which was on 621, is where the markets were selling off nicely when we called the top in the S&P, which was really in April. But it doesn't matter. This was a great move to $110. When the market had their rally, we put the top in right here on 7-1. And we all remember going into the 4th of July is that I said it was time to get net long because of the imbalance ratio between call and put side. And so on 7-1, they come back after 7-4, that first Monday, and they started to rally the market. And then the put side left. Of course, we were cashing in. But in the same area, the call contracts were giving up significant value. So let's take a look right here on this date on the this chart right here below the market. This contract right there, at that time, the high was 38.20. And from $38.20 for the month of August, this is the month of August that we were short buying lots of bear funds because we said that August was not going to be a good month, even though it was going to be a very low volume month, but that the trend would be down in August, and it was. And on the very last day of August, it was time to get net long, as we said. And what net long meant was that it meant this, that the call side of the market was totally deflated here, as SMF Street option traders know. They don't trade options, people that are viewing the video by luck, is that SMF Street traders are market makers. And they buy down here, where people held the contracts at $38 down here to $1.40. That was the volatility trade to put on. Ironically enough, notice the date, 8/31. And we've had 1 day, 2 days, 3 days. The high was $12 a contract. Buying the other side of the market as a risk management trade on the way that you're trained how to use our system, told as we were selling profit, and we've waited for several weeks. We are going to be able to buy this put contract at its all-time lows. People that stayed short the market have paid a price. So if you had 10 contracts at $60 a contract, that's $60,000. I'm sorry to inform you that those contracts today, as of right now, the last print was, the close was $12.60. Because SMF Street is taught, they don't use day trading option books and Gigma, Gamma, and Black-Scholes. Throw that crap out of there. This is about wholesale here, deflated, you buy it. This is inflated up here and it can't go higher, and you sell out, take your profit, and you buy that side of the market. Now, that was wholesale. The very opposite is going to happen here on the S&P put side of that 1110. The other thing, when I do the actual index itself, is as if the S&P can't clear above 1130, there's nothing to be constructive as far as I'm concerned on the bull side. Yeah, the S&P closed at 1104. When we travel back up to that neckline high and we don't get a closing price above 1130, hey, institutional traders, hedge fund managers are going to start dropping the bomb, and we're going to buy this over here. Just like we bought that cheap. Just at other times we bought that cheap in the cycle. But notice that the put side and the premium here, look at here. They only gave $3 premium on the call. But watch this. Look at the imbalance ratio. They took $9.90 out of the put. Both same strike price. So SMF Street traders, what has happened here is that the market makers on this side of the market have dropped the bid and walked it all the way down to buy it. They don't walk them down to the bottom of the floor without wanting to buy it. Just like coming over here and you bought 100 contracts for 14 grand, well, you're up almost 100 grand. That was a lousy $14,000 for this side of the market. So you do the math. Take $1.40, or let's say you're in at $2 on 100 contracts for 20 grand. And you sold them at, let's say, $10. You just made 80 grand in that 4 days. That's the bull side of the trend, because the bull side of the trend was deflated and the bear side of the trend was inflated. It's that simple, SMF Street. But what you need to know is where they're not given the kind of premium on the call side and they're stealing this premium here. Look at the ratio between the two. 990, both the same strike. Sorry, welcome to the world. No wonder you retail option traders get your head handed to you. Because you do. Because you don't know when to buy wholesale. You don't know the difference between inflated and deflated. I haven't found one person that's ever come through the SMF Street School that could tell me. Not one. People have come through here. Oh, I've traded options 10 years. Well, they find out in their first 5-day free trial here how much they don't know. Because you were led to believe that there's lots of things and brainwashed into believing that an option market should be a certain way. I'm sorry, a market maker is wholesale versus retail, in balance at wholesale prices, in balance at retail prices, and taking the spread and getting wholesale entries. Once I clear this video off, I will give the SMF Street traders off of the video the pricing structure. And we will be looking at where we hit the bottom. Just like we hit the bottom here, the bull side was to be bought because it was so deflated. You couldn't help but make money. This side of the market for the bear, that, yeah, for August, the bear worked real well. But they came in on 9-1 and walked that dog up and walked this one down. And they took lots of premium. These premium, look at how much they took out of the premium. $60 a contract down to last print at $12.60. You do the math. But on the other hand, you got to know when you're going in this side of the market that you're not getting a lot of premium. And that premium, they're not going to start giving premium until we get at least a closing price above $11.15. You'll start to see the premium change a little bit. Because this one was deep in the money, they stole more. Yeah, they do steal premium. What I want my SMF Street traders to understand clearly is that you had 24,723 contracts bought to the bear side down here versus the bull coming in and buying only 5,300 traded. Obviously, between that bull here and that bear here, you can see the balances in the trade management. And we'll talk more about that, SMF Street traders. And we're going to move on to the pricing. I'm going to close this video down. This is a wonderful thing for understanding why you made money. When will that premium, and we'll talk about it off the tape. We'll talk about where you get the bigger bang of this premium when it comes into play. And we'll talk about it off the tape of where your pricing controls will be in using our system, not the public system. Not your day trading system. not your option books that says do this and do that. I'm sorry, pal. If that worked, then everyone would be rich in the options market. If that stuff worked for you, but it doesn't. And we know that. It works for this. SMF Street Traders has opened the door to Main Street. If you want to take accountability and you want to see the accuracy, don't try to give an opinion as to what we know or don't know. Come and see it in live trading every day. Then you'll know.